Hi everybody, good morning. Thank you very much for joining us today for this Accentuate by K3 Hub session, which is the last of our K3 Hub webinar program for 2021. Session brought to you by members of the K3 Capital Group PLC, which is a multidisciplinary professional services group listed on London Stock Exchange. My name is Marie Wadeson and I am a Managing Director here at Quantuma, and on behalf of the K3 Capital Group, I also lead the K3 Hub. So for those who haven't already signed up to the K3 Hub, the K3 Hub is a membership group of over 1,700 like-minded professionals, which is powered by the members of K3 Capital Group. K3 Hub offers its members a range of benefits, including a CPD training program, which offers a range of structured CPD courses, some of which are delivered by Tollers on our half, and unstructured CPD training courses, with today's session being one such example. Our members can access the broad range of professional services offered by the members of our group, and for certain types of work, we're also able to pay a referral fee in return. A few pieces of housekeeping before we get underway today. We are recording today's session, and a copy will be available on the website in the coming days. We do have a full agenda, but that said, Q&A function is switched on. We have got some time allowance for a short Q&A after each of the speakers in the first half of the agenda. If for whatever reason we have more questions than we can respond to in that time, then what I'll do is I'll pass any unanswered questions to the relevant speaker along with your contact details, and they'll come back to you directly following this session. Right, moving on to the first item on our agenda then. So first up, I'd like to introduce my colleague, Chris Newell. Chris is a Managing Director here at Quantuma alongside me, and is based in our Thames Valley office. Chris is a licensed insolvency practitioner who regularly advises directors and shareholders of businesses. He provides them with restructuring solutions, pre-insolvency advice, and he also undertakes formal insolvency appointments. Chris, over to you.
Thank you, Marie, and good morning, everybody. Yes, I'm a Managing Director in the Restructuring and Insolvency division. I'm going to give a brief overview this morning on the current and future outlook in this sector. So a little bit of crystal ball gazing from me. As Marie said, there's some time at the end of what I'm going to talk about for some questions. So I'd love to receive those. So if you can submit those in the chat function, that'd be great. So just looking back over the last 12 months, it's been obviously really interesting times for us. And there has been a reduced level of formal insolvencies, and we've been about 30% down during the pandemic. The main reasons for that are the government support measures have been successful in protecting businesses from needing to go into formal insolvencies. What we've seen is that since the furlough ended in September, we have seen increased activity levels, and we're getting closer to pre-pandemic levels. But there is still that backlog of companies that didn't go into formal insolvency procedures, and we think we'll need some assistance in the future. So that's where we've come from, and looking back over the last 12 months, what we've been dealing with. Looking forward over the next 12 months to 2022, I think the major thing at the moment is the new variant Omicron, which has created significant further uncertainty. That's hitting the hospitality, leisure and retail sectors hard right now. I was reading some stats this morning about London office, people going to the office in London, and that's down to 10% levels. And for these sectors, December is traditionally their busiest and most profitable month. So the loss of important trade is going to hit many hard. So I expect to see an uptick in these sectors coming to us for advice in Q1. It's also difficult to predict how the Omicron outbreak will develop further. There's a lot of calling for government support measures to be reintroduced. That seems to be quite strongly resisted by the government at the moment. So the government seems to be determined to avoid a lockdown so that these measures don't need to be introduced again. So I think, again, we're going to see lots more support needed for these industries in Q1 next year. In terms of other sectors that we're starting to see, travel's one that's been quite high for obvious reasons, and construction is another one that we've started to see a lot of need for our services in. There's been supply issues and price increases in that sector, so I expect to see those sectors continue to need support. In terms of levels of insolvencies in 2022, I do expect to see an uptick in Q1. But I don't expect to see a huge cliff edge in terms of insolvency numbers. I think that the pandemic is going to create quite a long tail in terms of the need for companies to take advice, but it's going to take sort of 2 to 3 years and for that to kind of all come our way. So I don't see an immediate cliff edge in levels of insolvencies, but I do see them increased over the next 2 to 3 years. Hmrc, and this is a big one for me, and I think they're going to be a major factor in 2022, depending on their approach. They're now a preferential creditor as of December last year, so they've got more security when a company goes into a formal insolvency. So I expect that Hmrc will continue to support businesses with time to pay tax agreements, and we're seeing typically 12 to 24 months being offered by Hmrc. They are stretched at the moment, and they're diverting kind of historic resource from the support measures to more traditional sort of measures of collection and targeting fraud, which I'll talk about a bit later. But to put it into some kind of perspective with some numbers, Hmrc pre-pandemic had overdue tax of £21 billion. As of September 2021, Hmrc was owed double this figure, 42 billion. So it's a significant amount that they will want to collect in. So I expect during the course of next year, we're going to see some normal collection activities from Hmrc resume. I can see Hmrc starts tightening sort of over this time. So regular communication is important with them. And one of the major issues that I commonly see with Hmrc is when people go to them for time to pay agreements, they panic and they get the agreement for the timeline that Hmrc has offered and not the timeline that's right for the company. And so the kind of the time to pay agreement eventually falls over maybe after 3 to 6 months when they run out of cash. What they should be doing is looking at their cash flows and getting support with that from their advisors so that they get the time to pay agreement for the right amount of time. So funding, I'm not going to talk too much about this because Karl's going to talk a bit more detail of funding later, but it's tightening. Banks are now looking at lending under more normalized terms, and there's much more focus on affordability, which makes it more difficult to borrow. Banks are also aware of what I was just talking about of Hmrc being a preferential creditor. So it means that if a company goes into insolvency and the bank's looking to recover under their floating charge security, then it's going to be more difficult for the bank to recover where there's Hmrc arrears, which is quite common. But Karl will talk further a little later about funding. Fraud, I think, is going to be huge over the next kind of year, and I think we're going to see a lot more fraud coming out of the woodwork. It's typical that during tough economic times, people are more likely to take risks and commit this type of crime due to sheer desperation. And fraud can be misuse of a bounce back loan or something a lot more serious. So I do expect to see higher levels being uncovered as accounts are prepared. And there's a recent interesting case, Arena Television. They do a lot of the TV coverage for high level sports fixtures. So they'll be at Wembley, and they've got lots of equipment, helicopters, TV cameras. So that's typically under asset finance. And now this one recently, just surprisingly, just stopped trading. And a lot of the lenders kind of got together and were kind of speaking to each other about how much they're all owed. And it's been in the papers over the last couple of weeks, in the weekend papers. And the last accounts indicated that there was £30 million worth of bank borrowing on the balance sheet. And when the banks all started talking to each other, they quickly figured out that it was more like 10 times that amount, so £300 million of borrowing. So that's a really significant case, and I expect there to be a lot more coverage coming out on that one. But I also expect to see a lot more fraud just in general over the next 12 months. Another thing just that we're seeing is just distressed balance sheets. And this is sort of typical at the moment. We're seeing SME companies with balance sheets that are damaged. They've taken on huge amounts of debt. So whether that's Hmrc arrears, rent arrears where they haven't been able to pay rent sort of during the period of the pandemic, or COVID loans, bounce back loans, C-bills. And so there's a lot kind of going on now on their balance sheet. So they've got to sort of repay their own repayment terms for their COVID loans. And so we're now seeing them start to struggle where these businesses haven't picked up as quickly as quickly as they thought they might. So they are now coming to us and looking for terms to be renegotiated with creditors, landlords, Hmrc, and that's typical of what we're seeing at the moment. So many of these businesses over the next 12 months, and probably longer in fairness, will need to restructure. And so the key for them is just taking early advice from their advisors. So that's really kind of the climate at the moment. That's where I'm at. If there's any questions, I'm happy to take those.
Thanks, Chris. We have had a couple of questions in there, actually both relating to bounce back loans. So
right.
First one reads, how many companies with bounce back loans are you seeing needing to take advice at the moment?
Yeah, lots, Marie. So pretty much every kind of company that I'm seeing at the moment needing advice has either got some form of bounce back loan or CBILS loan in there, and they're unable to repay them. So typically, as I was just saying, it's part of a much larger creditor position. So there'll be Hmrc arrears, landlord rent that's due, and other trade creditors. But it is typical now that every case I'm sort of dealing with has got a bounce back loan in or similar.
Okay, thank you. And the second one follows on from that. So what is happening to directors of companies where bounce back loans have been misused? Okay.
So if the company goes into liquidation, the bounce back loan misuse can be uncovered fairly quickly, because the liquidator's got a duty to investigate the transactions of the company. So what we'd do is we'd get the bank account statements and look back and see how that money was spent. So it's quite easy to see what's happened. So if the director has transferred monies to their personal bank account, which I've seen on quite a few cases, or gone down to the local Porsche dealership and bought themselves a brand new shiny car, it's actually quite easy to kind of uncover that. But then you uncover it, what next? And then we would sort of write to the director, ask their understanding of kind of, why this transaction was for the benefit of the business, and then seek to recover the funds. So, and we've been successful in doing that in sort of some cases already, and where we've recovered funds. And there's also the prospect of the director being disqualified. And there's been some quite recent cases where directors have misused bounce back funds, and actually fairly low levels, to be fair, sort of £12,000 to £13,000. And these directors were disqualified for quite a long period of time. So 6 years plus. So it's good to see that action is being taken where there has been misuse of these types of funds.
Thanks, Chris. And one final one for you, just to put you on the spot.
Okay.
Top tips for the advisors on today's call in terms of protecting the position of their clients into the new year. Top
tip to communicate is the main one. So where you owe monies to Hmrc, trade creditors, landlords, communicate. Sticking your head in the sand is probably the worst thing you can do, because creditors can now take legal action again. Landlords will begin to sort of tighten the screws sort of after March next year. And so you just can't keep sticking your head in the sand. Communicate and take advice.
Very good. Right. Thank you very much for that, Chris. Okay. Right, moving on to my my second speaker of the day. So next up, Karl Holmes. Karl is a managing director at our sister company, K3 Debt Advisory. Karl is a qualified chartered accountant and has worked in corporate finance and restructuring. Alongside his team, he advises clients on a range of acquisition finance, shareholder recaps, working capital and growth / development capital on deals ranging from 500,000 to 30 million. Karl, over to you.
Thank you, Marie. Good morning, everybody. Pleasure to speak to you this morning. So I'll start with a quick look at the wider economic picture and the implications that has both for lenders and for borrowers. And then we'll look at an overview of the steps we think borrowers should be taking before they approach the debt market to look for funding. So the background to the debt market, as Chris has discussed, government financial support is tailing off. The only piece of government support remaining in place, the restructuring loan scheme, is reducing from 10 million to 2 million on 31st December. There is no indication of other forms of support at the moment, but obviously the situation is moving very fast. Difficult to read how support would be supported in the House, given the backbench response to the recent partial lockdown measures and dissent over tax rises, which would obviously be the other part of that equation. And Chris also talked about how CBILS loans are now needing to be repaid, which has obviously adding to the cash pressures on businesses. Other defensive measures are coming to an end. Hmrc will be looking to recover those arrears that we talked about, and landlords are going to be looking for solutions to their situation, and the courts are now open for creditors to be more proactive. There's uncertainty over COVID, and the situation with Omicron does seem to be seeing people move back to an informal sort of lockdown that they're imposing on themselves. It'll be interesting to see whether this is just a seasonal effect, or whether we return to the sort of the lower spending, higher saving pattern that we saw in much of 2020. There are, of course, the other economic headwinds, which are very well talked about in the press: inflation, labour shortages, tax rises. So I'm not going to dwell on those. Just to say, really, obviously, if those situations continue and demand softens the way that we've seen in the last 2 to 3 days, then it's going to be a very tough very tough few months for many businesses. So what does that mean for lenders? Obviously, the lending market is the key part of how borrowers think about going to get the lending that they need. I've talked on a previous webinar about how the response to the domino effect caused by the global financial crisis was the Bank of England to systemically de-risk clearing banks, primarily to protect the infrastructure of the day-to-day sort of corporate and personal banking environment. And as a result of that systemic de-risking, those lenders have consciously stepped back from many parts of the SME and lower mid-market that we all operate in. And given the scale of their previous involvement in that market, this stepping back has created a sizable void in the provision of debt facilities for companies in the SME and lower mid-market. As well as stepping back, we've talked about the fact that people are spending less and saving more, and that's actually created a relatively benign environment for the larger lenders, which was reflected in the Bank of England's report earlier this week, where they stress tested the 8 largest banks and decided they were in good health. The balance sheets are robust. So even after applying sensitivities of a severe recession, the capital levels were estimated to be at the region of a 10.5% against the Bank of England's target of 7.6. So a material headroom there for the larger banks. But for the smaller lenders that don't have deposits and are reliant on external funding, be that equity, family money, peer-to-peer, institutional wholesale funding, that's a different situation, and all of those funding types come at a higher cost, and very often with a limited time horizon. People don't commit their money, sign die, as it were. They have a period of time in which it needs to be invested, and that puts a different pressure onto those smaller lenders. And that situation is likely to become more pronounced as interest rates rise, which I think is the consensus over the next sort of 12, 18 months, because currently the very low interest rates are driving investors who previously stuck to fixed income products such as bonds into the corporate debt market. So as interest rates rise, small lenders who are providing a return either to private debt funds who are looking for alpha returns, so that the amount of money they need to make over and above the risk-free rate will go up, or to pension funds who may even actually move away from the corporate debt market. They were driven to invest in corporate debt by ultra low rates. They may decide partially or completely to move out of that market. And it's obviously unlikely that corporate debt class will become undercapitalized as a whole, but elements of it might, and individual business models can fall out of favor, and particularly those lending against a particular security type or sector or income bracket. And I would say the SME and lower mid-market might be one of those that becomes less attractive. And if that happens, some of the smaller lenders might find themselves underfunded. And as anecdotal evidence of that, I've spoken to 3 lenders in the last 2 weeks who are now looking for new funders in order to be able to replace the funding they need to continue to grow their book. So they're coming under pressure in terms of the funding they've got to put out into the marketplace. And the upshot of this is that the supply of debt to the SME and lower mid-market will continue to be fragmented. That's a matter of policy. It's not going to change. And it will continue to be unpredictable due to the nature of the firms that are now supplying that sector. And what does all this mean for borrowers? Well, there's going to be a flight to quality, as is often the case when times turn difficult. If your client's business is growing to plan, hitting its targets, it's got predictable income from a diverse customer base, and they've got inelastic demand, so they're able to absorb price increases from your client, then they're fine. They're gonna be able to get the funding that they need without too much difficulty. And similarly, if your client operates in one of the hot sectors such as technology, life science, non-domiciliary healthcare, there are others, then even if they're reasonably well managed, they'll get plenty of choice for the day-to-day funding that they require. But even so, in the market, we're seeing larger lenders not supporting something that might be considered outside the ordinary course of business. We're advising a very stable company working in the technology sector at the moment. They're looking to carry out a relatively unambitious acquisition. They want to borrow 1 times their own EBITDA in order to leverage up and make that acquisition. But their high street lender isn't even supporting that request, that they're uncomfortable going to that level. So there's a lot of conservatism out there at the moment. And so from a borrower's point of view, in order to decide what they need now, they really need to think about what they need in the future. It would be really helpful if you could get the owners and the shareholders to sit down and think about where they want to be in 5 years' time, or how they want to exit their business. Because in order to get there, you can work backwards to what you need by way of working capital, organic funding for organic growth, capital expenditure, and maybe even acquisition finance in order to get to where you want to get to. Now, of course, that's an ideal scenario to have such a well fleshed out strategic plan, but any form of planning should be able to narrow down the sort of funding that you're looking for, and you're more likely that way to end up with a facility that's fit for purpose rather than one that the lender is pushing on you as their preferred product. I think the main takeaway from this should be to consider all the options. I've been involved in funding and debt advisory for a long time, and I still meet a lot of advisors who regard invoice discounting as something to be avoided if possible. In my view, if your client has short-term profitability issues due to COVID, and we're going to see a lot of that over the next 12 to 18 months, but their sales are growing as they adapt to the new market and their debtor ledger is good, then invoice discounting might well be the answer for them to get back on track to more sustainable levels in the future. They may be able to look at term loans, but invoice discounting is definitely something they should be thinking about. And if you really have concerns about it, then I'd urge you to give me a call before ruling it out as a possible means of funding for your clients. Other assets, unencumbered fixed assets, can be used for asset finance. You should think about looking for any tax breaks that you can get. We have an R&D colleague who will speak to you later about that specifically, but reclaiming losses, super deductions and the like need to be thought about. Most owner managers will be over-invested in their business, but if that's not the case, if they have got some spare cash around, then maybe look at a director's loan and a vendor loan, a director's loan note rather than bank borrowing or alongside bank borrowing. It's worth bearing in mind at this stage that even with security over assets now, many lenders are going to be looking for a form of personal guarantee. Even the recovery loan scheme allows them to take a limited personal guarantee. And it may be that giving some form of guarantee or secured personal guarantee is the key to unlocking a good deal. But I think it's really important that the potential guarantors have a chance to think about that and think about their approach to that before they get wrapped up in the momentum of deal and before they're under pressure to put that in place. They want to get comfortable with their view on it before they need to think about it in the heat of the moment, so to speak. And it might be that there's a third party, either an acquaintance or a business colleague or someone who wants to invest in the business rather than take it over, put some money into the business. So if any of those options are available, they should be explored before looking at the debt position, because it may be that to get to the debt position you want to get to, something like that helps you to get the deal done, or it might actually be a better option if you look at the two side by side and the debt is very expensive, because debt is going to be expensive going forward. And these judgment calls are difficult. If someone's looking to invest 25% of the business and take 25%, it's not a controlling stake, it's a minority stake. And you're looking, the option to that is an expensive loan that might be charged at credit card rates. Then if the business struggles and that loan becomes too onerous and may even lead to the failure of the business, then clearly that's a very high price to pay. But if the business thrives and trebles in value, then the equity suddenly looks very expensive. There's no right answer to these conundrums, but it's really helpful to have thought about them in advance before going into the debt market. So the best way to approach the market: move quickly. Uncertainty increases over time. Look, small loans, asset finance can be acquired online very quickly with limited bank statements and management information. But providers of more material facilities will look for 3 years full accounts, year-to-date position. They want to see forecasts for the next couple of years. They want to see sensible flexing. They want to discuss the underlying assumptions, the main drivers of income, profit, and cash in the business. So engaging lenders without this detail isn't going to speed up the process. It's just going to lead to a longer lag time before you actually get to the lending decision. I've seen a number of offers fall away because the confidence with business development managers looked at the headlines and thought the business meets their criteria, and the credit committee have looked at the detail and decided it doesn't. The longer the process takes, the more chance something will change. It might be the company's performance. We had a client who suffered their worst month in the year. The week before the credit hearing, the deal fell through. It might be the bank that suffered. Chris mentioned the Arena case. That stung a number of lenders directly, and it will sting a lot more that will be nervous as a result of it. And also, the longer the discussion takes, the less likely it is a proper competitive process can be sustained. Lenders will use attrition as a way to gain exclusivity, and exclusivity is a way to improve their own negotiating stance. Because the more time management have invested in the process, the less likely it is they'll walk away, even if the deal is not what they really wanted. Yes, good things might happen, but it takes a lot longer for credit teams to build a confident outlook than to pivot to a negative view if they see things going wrong. And I, to be honest, see very little on the economic horizon to suggest that credit will be changing their view for the better over the next 12 to 18 months. We talk about a short-term fix, getting some lending off the website, but it needs to be the right sort of lending. A short-term fix can become the next problem. We helped a client who borrowed money via a website lender. It was very quick, it was very easy, but it turned out the repayments were based on turnover. So as his sales grew, the repayments ramped up and actually soon became a constraint rather than a solution. And we were able to refinance that and get a longer-term loan in place, which gave the director time to get the sales growth and the profit ahead of the debt service and actually have cash to invest in the business. But he moved too quickly and it actually turned out to be a problem. So the old adage, if you fail to plan, you plan to fail. Get all the information prepared so you can send a flyer and an information pack out quickly once you've decided the lenders you want to speak to. Take control of the timetable. Be clear on goals, what it is you want to achieve. Your client knows where they want to get to. You've got some real stepping stones to get there. Having those aspects of the deal up front and central when you're negotiating means that you talk about them and you can quickly filter out lenders who can't provide those elements. So as an example, if the director is putting money in and paying interest on that money is essential to their going forward with the business, then make that clear in the first conversation. Some lenders will allow directors to take interest off the table, others won't. You need to be clear on what's available. You don't want to be having that conversation 3 or 4 months down the line. You also need to be prepared to compromise. It's a seller's market. Very few companies are going to be able to completely dictate terms. So as with any negotiation, helps to find some elements that are nice to have, but not essential. So these can be given up in the latter stages of negotiation. And be focused on getting through to the right result. Even those borrowers that have been courted by lenders need to take control of the process. If they're passive and allow the lender to lead negotiations, they'll probably end up with a facility that costs more and importantly is actually weighted in the documentation in favour of the lender. A one-sided agreement allows for the facilities to be reduced or even withdrawn at short notice. The lender can unilaterally limit their exposure if they become worried about the business or even the wider economy, and clearly that's unhelpful to the borrower. You need a clear understanding of how the legal documents apply, the commercial arrangements, and how the covenants are calculated, and the implications of failing a covenant. It's critical that you're able to work with the lender in advance before you do that, so that you don't give them any nasty surprises. You want a good working relationship with the lender, and although there's no guarantee to how lenders will react to bad news, it's much better if you've got a good working relationship, and that's less likely if you've had a real ding-dong in the final stages of a negotiation. It wants to be even-tempered, it wants to be considered. An outside view can be helpful at that stage. So, quick sell, the team at K3 Debt Advisory, we work for banks, we've worked in industry and borrowed from banks, and we've advised many corporates on borrowing over the years. So we bring the market knowledge, we bring experience of borrowing and allied that with a poacher turned gamekeeper understanding of how banks work, so we can identify and we can iron out these one-sided clauses and help you to reach a fair and balanced outcome. That's it from me. Thank you for listening, and I'll hand back to Marie for any questions.
Very good, thank you, Karl. Some very good tips in there for our delegates today. I have had a couple of questions in. So one from Paul here. What are the terms of the revised recovery loan scheme when the terms change after the 31st of December? Yeah,
thank you. So the headline is that the balance is reducing from 10 million to 2 million. So obviously it's much focused on much smaller businesses. There are other tweaks around it, notably the reduction in the amount that the British Business Bank is actually guaranteeing, so that will impact on pricing. I think the main takeaway from the RLS is that there are different lenders who are accredited to give it, and different lenders have very different views in terms of how to give the scheme and the time that they will allow it to be repaid and the interest rate that they will apply to it. So I think we're planning to send out something in the new year to look at the way the recovery loan scheme is being run, and also to cover anything that might be picked up over the next 2 to 3 weeks. So watch this space. There'll be more coming out on that front, Marie.
Okay, good stuff. Thank you. And then one here from John. So you touched on some sort of short-term loan facilities earlier. So John's question reads, is it worth looking for a short-term facility, let's say 6 months or so, to see how the year pans out?
Yeah, I mean, clearly there's a lot of uncertainty about, and you know, the traditional loan facilities of 3 to 5 years seem a very long time in the current circumstances. And a short-term loan, you know, might be a good bridge to where you want to get to. On the other hand, it's going to be more expensive. The transaction costs will make it more expensive, and it's still got to be the right sort of loan. I mean, as we highlighted in the presentation, we spoke to a client who had taken a short-term loan. It seemed like the right thing to do at the time, but actually the structure was wrong. The cash payments were structured inappropriately, and that made it actually more of a burden than a benefit. So it's got to be the right sort of loan. Tenure is just one of the many aspects you need to think about. So yes, in uncertain times, tying yourself down for 5 years does perhaps feel a bit difficult, but get the underlying structure right is the main point.
Great stuff, thank you. Right, just moving on to our final speaker in this part of the agenda, I am very pleased to be able to welcome back my colleague Nigel Langrick from one of the UK's leading R&D tax credit specialists, randd UK. Nigel is a senior member of the randd UK team who has secured over 150 million in tax credits for their clients, proudly hold 100% success rate for claims, and have an excellent relationship with Hmrc, and they have successfully submitted well in excess of 3,000 claims on behalf of their clients. Nigel, over to you.
Morning, thanks Marie. Good morning everyone. Yeah, so today I'm just going to cover a few sort of updated points from the last time that I did one of these a few months ago. So we've had the autumn budget since then, so we'll just sort of see what was R&D relevant in that. Some changes in Hmrc and some updates on some of our inquiries that maybe last time I did one of these had just started seeing more inquiries fall through. So we'll have a quick talk of some of those and some of our experiences with that. And then we'll close off with a recent case between a construction company, I believe it is, and Hmrc, and what the result of that decision looks like for the R&D sector. So firstly, on to the budget outtakes from the autumn statement that Rishi Sunak made. I mean, he did spend probably a good 10 minutes talking about innovation within the UK, and R&D makes up part of that, and the continued support and investment that the government wants to make in making British companies innovative and pushing technology forward. So there are changes that they wanted to make the R&D scheme particularly more relevant in future years, and those changes, the first of all is to bring in cloud computing costs and data costs. So from the consultations for R&D over the last couple of years, a lot of companies have been saying that they need, or a lot of their research and development is now being taken up by costs of buying data sets or having to use cloud storage. And it's something that's not, historically been allowed. It's not a raw material, it's not labor costs. But the argument has been successfully made that for some projects, or for many projects going forward, this is going to be as relevant as labor and as relevant as raw materials. it's going to have to be purchasing of these for direct use within the R&D projects that the company is making. So if they're producing a product and they're buying a data set to test that, then the data set is just for that project, then they're allowed to use that implicitly, and they can claim those costs for the R&D credits. But if the data set has inherent value after the research part of the project, then they're going to have to maybe apportion that or not include that in the claim. And the same with the cloud computing. If they're buying a cloud software package that is solely for the R&D project, then fantastic, they can include those costs. But if it's going to go beyond the R&D project and have other uses, they're probably going to have to apportion that, either based on being able to identify within their billing which items are relevant for the R&D, or just doing some kind of fair apportionment across the whole cost. And then the second change, which is possibly going to reduce the scheme for some people, is that they're going to refocus the relief towards being more UK based. So what that means really is there are many companies that maybe outsource testing or outsource some development to somewhere else in Europe or the Far East, where they can have a team of developers working for a much lower cost than it would cost to do exactly the same project in the UK. And the government are going to kind of change the scheme to only allow those kind of costs that are being worked on in the UK to be included within the R&D claims going forward. So it's something that you can understand why the government are doing it. They don't want to be supporting research development that's happening elsewhere, really, but it's going to, for a number of companies, reduce what they can claim. However, both of these planned changes come into effect from April 23. So there is time for those companies that are affected by that to maybe make a decision on, is it worth them bringing that back into the UK so they can get the relief in the UK, or are they happy to reduce the relief they're going to get because the cost differential is so great that it's better to keep that still abroad, like I say, somewhere like India or sort of Eastern Europe, where some of these costs are much cheaper. So the next point that we want to look into is a quick update on Hmrc. So last time when I did one of these around September, I think we'd said there was 100 inspectors that had gone into the incentives team. Now there's been a further 100 since that. Now the incentive team is not solely R&D, but obviously, a big portion of that is R&D. So they, again, they are looking to clamp down on some of the spurious claims that have been getting through in the past, when maybe this was a section of Hmrc that was maybe understaffed, and increasing the number of inquiries that they're opening, or just looking into the claims in a little bit more detail before making out payments. We're definitely seeing that claims are taking longer to process at Hmrc. I think this is a combination of, as I say, they're being looked into in a little bit more detail, but it's also, I think that they are just suffering such a backlog of claims from when they maybe had moved staff around in Hmrc to deal with some of the COVID support last year. So we are seeing claims take longer. We are seeing claims that are a bit more complex in the way that they're being repaid take longer. So the introduction of the 3-year carryback, the carryback aspect of claims is what we see is taking much longer to be repaid to clients, which can be frustrating for some clients. And we do have clients sort of call us on a regular basis, checking where their claim is at, sort of maybe a bit worried. For the most part, it's nothing to worry about. It's just that Hmrc are looking into those in a bit more detail, maybe recalculating it again and again, just to double check the figures that are being submitted. But all we can do really is keep chasing Hmrc and just getting updates where we can. It's kind of out of our hands. It's at Hmrc's discretion as to how and when they pay and how long they take to pay. And then maybe the biggest point on the Hmrc update is the inquiries that we are now seeing. So last time I did one of these, we spoke of randd having seen more inquiries coming through for our clients, still a very low proportion of our overall claims submitted, but quite an increase on previous years where we maybe had 1 or 2, we suddenly had maybe 7 or 8 inquiries ongoing. So luckily for us, over the past 3-4 months, we've started to see some of those inquiries come to a conclusion. And the 3 that we've had concluded so far, 2 of which have been, quite pleasing for us. Hmrc agreed with our claims entirely, and there was no no adjustment made. So one of those was a food processing company where I think they deal in solely cheese, and they were Hmrc were arguing that it's not really R&D, you're doing very much what other cheese manufacturers are doing around the UK, but we were able to argue that what they're doing to maximize yield or minimize waste was so specific to what they were doing and so unique that actually, that the processes they were undertaking did qualify under the scheme. Another quite interesting inquiry that we were involved in was a energy monitoring company. So they were developing smart meters, and I suppose from the offset, Hmrc maybe quite rightly took the view of, well, smart meters are widely available, E.ON, Scottish Power, all the big energy companies are fitting smart meters in people's homes. But what this company was doing was developing smart meters for big industrial and commercial units. So they were able to identify within those units which areas of the building, which rooms, or which specific machines were either inefficient or very efficient. So they could then target how to best use those machines, or if they needed to update them to a more efficient process going forward to help reduce their costs for their businesses. And Hmrc, after some back and forth, did agree that there was enough innovative changes to how they were producing these smart meters, and the research was going down to the very components of the smart meters as opposed to just the final product, that they were happy to accept the claim. And then a final one, which we also had a successful result, but Hmrc did slightly reduce the claim, having sort of some back and forth on some costs that they thought should be stripped out, was a metal fabrication company. And absolutely, from the outside, most of their projects are run of the mill, and we would agree with Hmrc on that. But there are, even a company that does a lot of run of the mill stuff will have the odd one or two projects every so often that are very specific, and they are looking to, do something unique to that scenario. And luckily for us, with our relationship with Hmrc and the inspectors, that we were able to have those meetings with Hmrc, present the evidence as they wanted, and the claim, although was slightly reduced, it was very minimal for the overall claim size. So what does this really mean for R&D tax credits and claimants or potential claimants? We have definitely seen some people wanting to, or being a bit more nervous about claiming because they've heard about the fact that there's more inquiries going on, or they're worried that if they'd make a claim, they might trigger an inquiry, where if they don't make a claim, they'll avoid inquiries altogether. I think the evidence is there that if you're going to make a legitimate claim and you are confident and you meet the criteria, and you maybe have that expert guidance to help you through that process, that yes, there is a very small chance of an inquiry being raised, but as we've seen here, there's also a good chance of those inquiries being successful from the client's perspective. So it shouldn't put people off making a claim if they feel they have a legitimate claim. It's more, this is more about making sure that Hmrc are not letting through some of these spurious claims, like I said before, and ones where maybe someone's just put a number on the tax return as opposed to really backing it up with hard evidence. And then the final part for me today is to go into an interesting case that we've seen recently. So in the last couple of months, actually, Quinn London versus Hmrc. But first, I'll give you the lay of the land as to why the Quinn case is so interesting for us in the R&D world. So of late, Hmrc have been using a precedent set in Hayder versus Hmrc, where the first tier tribunal found in favour of Hmrc. Now, this case is surrounding subsidised R&D and the fact that if a customer comes to your client, the one who's looking to make the claim, and has a project, has a product they want, has an end goal, and asks for this to be produced, then the company, if it's new, if it's a new product or something that's not been done before, they obviously need to do their own R&D with it in-house to get to that final product. Now, previously, the first tier tribunal found in Hmrc's favour that this was subsidised R&D, and the effect that has is that for that project, the company should claim under the RDEC scheme as opposed to the SME scheme. Now, the RDEC scheme traditionally, and what we see, is around a third as valuable to a client on average. So, it does have quite a big effect on the claim size to the client if they're having to make these claims under the RDEC scheme. Now, what's recently happened with the Quinn London case is that Hmrc found in favour of Quinn London in a similar scenario. So this scenario is that they have their customers coming in, they want whatever to be built in their construction industry, and Quinn London have to go away and do their research, do their development to get to that final point. In this instance, like I say, the Tribune found in Quinn's case, because one of the main arguments was, if you're going to be doing research and development, you're going to want to have a commercial benefit to that at the end. You know, there's not many processes where you're doing research and development without this end goal, without this potential commercial benefit to your company. And they're going to want to seek to recover some of those costs by sales towards the end of that project. But it's their R&D. It's Quinn's R&D. It's not really subsidised. You know, they've not been paid up front, and it's not in the contracts with the customer to say we're going to reimburse you for these costs. You know, if it was paid up front, we would absolutely take the view that, well, you're not taking any risk, so the risk is entirely not there for you, so you can't claim on the SME scheme because, you know, you're not really losing out. Obviously, if you're up fronting up the costs and only getting paid for the sale at the end, you've taken all that risk in the however many months it's got to that point of the final sale. So this is, you know, massively beneficial to a lot of clients going forward. Hmrc had been using the Hayley case quite often to kind of try and prove that there was subsidised R&D. Now clients have got the defence of this Quinn case to say, well, no, yes, there is this end goal that customers asked us for, but we've had to do all these steps to get there. And I think the good thing about this, it prevents the potential narrowing of the SME scheme going forward. If this hadn't been found in Quinn's favour, then, you know, there might have been a lot of companies out there suddenly having to make claims under the audit scheme as opposed to the SME scheme, which would have, you know, as I say, cut their benefits by 2/3, and it would just made it a much more or a less appealing process to go through for the clients. You know, if they're suddenly not getting the returns that they've historically seen. So I think that's all of the updates from me for today, and I'll happily invite any questions that you may have.
Very good. Thank you very much, Nigel. Just one question for you actually today.
Yep.
Mark has asked, are you seeing Hmrc target certain sectors or companies with claims over a certain value to open inquiries against?
The short answer is no. Historically, I suppose we've seen that smaller claims have maybe not been looked into in as much detail. But one of those 3 examples that I was talking about before was actually a claim where the client was due, I think, around £10,000. Whereas in the past, we maybe would have seen Hmrc overlook that and maybe just pay that out, do a little bit of a check in house. The fact that they've now opened an inquiry against a client with such a small claim in the grand scheme of things suggests that that is not the case. With regards to sectors, again, we've not seen it be specific to any sector, but then we do know that Hmrc are trying to cut down specifically on some of the software claims that are maybe a bit dubious. That might be because people have been making claims for software projects that in fact are just using off-the-shelf software, maybe manipulating it very little, but it's not something that is unique to them in any way, or something that they've put a lot of time and effort into developing something specific for their usage.
Great, thank you very much. Right, well, that brings to a close the first half of our agenda. We've got some contact details on the screen. If you'd like to make a note, I think that we will follow up this webinar with a quick email in the next day or so, and that will also include contact details. But in the meantime, just before I move on to Shane Lukas, our special guest speaker today, just a quick plug for our webinar program. So after today, we take a break. For all the accountants on the call, you'd be glad to know that we will not be running any webinars during January to let you get on with your busy season. We will be back on the 11th of February with a compliance update. It's a CPD accredited event run by delivered by Tollies. Our speaker will be Jeremy Mindell. Some of you on this call may have heard Jeremy speak. He has spoken for Quantuma on many occasions. Amongst other things, he'll be discussing the process for clawing back COVID grants. You will get your invite in the new year, and we hope you can enjoy us. Right, so I can see that Shane has sort of come out of the wings. switch this camera on. So very pleased to be able to welcome back our regular guest speaker, Shane Lukas. Shane is the Managing Director of AVN, who offer coaching and training to assist in transforming professional practices into rewarding businesses. I think rather than me cover off what your session is going to include today, Shane, I'll hand over to you and let you do that.
Thank you very much, Marie, and welcome and good morning, everybody. I just want to say thank you, by the way, to Karl, Chris and Nigel. Really informative presentations, and certainly I've taken lots of great notes from that to feed on to other people as well. So thank you for that. Also, thank you, by the way, to K3 Hub for inviting me here today. Now, if you're able to, please say hello in the chat box. It's always great to see that people are here, they're focused, they're listening, and I can see who's focused on my session today. Now, I just want to make a promise to you here. In the next 45 minutes, now I promise not to go over that, I'm going to share with you some very specific ways to increase your value perception in a way that means that you're going to be winning much more work and also get much more respect and appreciation from your clients, because quite often when we're not pricing right, that can also have a direct correlation to how much appreciation and respect we get. I believe that you guys deserve to be much more well rewarded for the great work that you do. So stuff I'm going to be covering in this session. First of all, I'm going to share some of the common challenges that people face, but also 13 mistakes when it comes to pricing that many accountants make. So maybe you'll not be making all 13, but maybe there might be one or two in here that you can think, yeah, okay, I do that. I'm also going to share with you then 9 simple ways to increase your value perception. Remember, value is something that we perceive. And as long as the value outweighs the price by far, then we're going to be happy to pay that. So if you can increase the value perception, then actually you can increase the price and people will be happy to pay that. And there are many benefits that come from that for you and, of course, the client as well, if they're paying you more. And then I'm going to just share with you a couple of the objections, the challenges that people get when it comes to pricing. For example, when people say, look, just skip all the stuff, just tell me what the price is. We hate that. We haven't had a chance to talk it through properly. So I'm going to show you how to handle that. And also when people just say, you've had a thorough meeting, you've shared all the benefits of working together, you've shared the price, and they say, let me think about it. So again, I'm going to share with you how to deal with that. Now, obviously in the next 45 minutes, 43 now, I can't teach you how to completely transform your practice. I can share with you some stuff that works, but if you can take at least 1, 2, 3 golden nuggets away from this session, I hope you'll agree with me that it will have been worth it to you. Okay. Now, first of all, why should you listen to me when it comes to pricing? Now, I have been helping accountants for the past 23 years to, amongst many, many other things, increase their pricing. In fact, it's one of the first things that we start with. We actually, back in 1999, developed the world's first value pricing tool. Now, there are many fixed price tools out there, but we developed the first value pricing tool, which of course we still have evolved and many accountants still use today. And that just allows them to very easily demonstrate the value and show a price that reflects that value in a way that customers are very happy to pay. It's not just about the software, though, of course, it's about the approach, it's about the conversations that you have and how you structure those conversations, and it's about how you demonstrate the value that you can provide. Now, as I say, I can't do 23 years of research in the next few moments, but I can give you a taste of today. And look, if you're interested in learning more, and today isn't about me plugging any of my events, but I am running a masterclass in March where pricing is heavily included. So look, if you're interested in finding out more about that, just check out my website. Under events, you'll find out the masterclass. So look, let's dive in. I know that most accountants, most business owners, quite frankly, hate pricing. How do you come up with the price? Having those discussions, we can have a really nice, pleasant conversation. And as soon as it comes to talking about the price, the throat dries up a little bit. We start to feel a little bit nervous. Now, I don't know if you've managed to switch on the chat box for me. I don't appear, by the way, to be on on full screen. I wonder if somebody could just spotlight my screen for me, because I'm going to share some slides and they won't show up properly unless I am unless I'm maximized. So if that could be done, that would be fantastic. And whilst that is being done, sadly I can't do that myself. But yeah, if Helen or Marie or anybody in the background could just make me large, then that would be fantastic. It says I'm on full screen. Okay, now it's showing me that I am, but it wasn't before. So that's fantastic. Thank you very much for that. I may well have been, but from my point of view, I was this tiny little postage stamp in the corner. So I'm very grateful for you doing that for me. Right then, okay, let me just, I want to switch on my slides, but at the moment, my slideshow has stopped working for me. Here we go. Right then, let me switch on my slides. Hopefully you can now see them. Now, look, accountants often say to me, you know, not working. Here we go. Can we see it? All right. We're getting there, slowly but sure. That my clients don't take my advice. They don't value me. They don't bring me the information that I need when I need it. They often say that I feel unappreciated. And there's an expression I always give here. Look, you know, the more they pay attention. And quite often, as I said, there's a direct correlation between how much people will pay you and how much respect, appreciation, how much attention they're going to give you. So I just wanted to take that away. I shared earlier about the masterclass. AVN members, people that we work with, on average are generating fee income, even just for the compliance work alone, 50% higher than many other accountants out there. And in addition to that, they're cross-selling additional services. That means their average fee per client is skyrocketing. They're delivering many more services. Many of these services, by the way, are high impact but low effort, which means they're much more profitable services. Their clients are incredibly happy because they're getting the type of service that they really want and need. And of course, the accountant themselves get to work fewer hours as a result of that. So I want to share with you 7 reasons why you should increase your fees. First of all, again, many accountants, this may or may not include you, are trying to undercut or at least be competitive with their pricing. And the downside is that the person that you're trying to undercut or at least match is probably undercutting the accountant up the road, who's undercutting the accountant up the road. And this is just going to be a downward spiral, isn't it, of less and less profitable work. When you're charging a better fee, you can justify spending much more quality time on each of your clients. Quite frankly, most people don't go for the cheapest option, but the most compelling. Now, if they're not compelled by the value, then yes, they're going to be, certainly appear to be price sensitive. But actually, if you can demonstrate the value, then price isn't the most important factor. In fact, quite often, the lowest price gives the impression of poor quality, isn't it? When you are charging better fees, then you can afford to work with fewer better quality clients. That means you're working less and therefore spending more quality time doing the stuff that you love. It may not always be spending more quality time with your family, of course. It also positions you better in the marketplace, and you can afford to recruit team members at a higher level as well, because you're able to pay a more attractive salary. So there's a few reasons there why it's important, not least because it allows you to deliver the level of service at the standard that you want to, without feeling that you've got to try and rush this out in order to please the client or make it as profitable as possible, and just do the minimum required to get it out there. Now, I said I've got some mistakes to share. There are 13 that I'm going to share with you. Sadly, there are many more mistakes, but the 13 I had to stop at in order to make the most of this session with you. So I'm going to go through them fairly quickly to stay on track. Mistake 1 is that many accountants out there will advertise their prices on their website. Now, you may think you're doing the right thing. You may think, well, you know, you're setting the scene here. You're being selective in terms of people that might be looking for a cheap price to say, well, these are our cheapest prices. But people are making an instant perception here. It may be that you come across as too cheap for some people, because people might think, well, actually, if that's all they're charging, maybe they're not going to do a very good job. For some, you might come across as too expensive, of course. But either way, it's impersonal. You've not had the opportunity to understand them, to take a genuine interest in their wants and needs, and therefore propose something that's going to fit exactly those things. So as a result of that, you're going to lose a lot of people before you've even had a conversation with them. And, you know, the people who maybe do come your way are just looking to buy a commodity. They're just looking for a price that works for them. So my advice is avoid making that mistake. Mistake number 2 is people will state a price based on an in-head calculation. They'll just, yeah, it's going to be this price. And again, you're setting yourself up for negotiation there, because they think, well, where's that number come from? I think you've just made that up, and therefore they're going to start bartering with you. It also appears to lack any substance because they don't really fully appreciate what they're going to get for that. Another mistake is that you'll give a price range and say, well, look, it's too early to say right now, but it's going to be somewhere maybe between 2,000 and 3,000 a year. We'll know better as we progress. Now, the downside to that is, which price do they remember? They remember the lower one. You remember the higher one. That just leads to disputes, frustrations. And even if you compromise, you're both going to feel cheesed off. So let's avoid that mistake too. Mistake, by the way, I can't see my chat box. If you've got any questions for me, if anything coming into the chat box, please do feel free to ask, but I will have to flick across and look every now and again for that. Okay, so that's cool. Right, okay, so mistake number 4 is, and I mentioned this already actually, you change your tone when you get to the price. And we can often come across as just looking very nervous, the throat dries, and the downside to that is, of course, that comes through. It can infer a lack of confidence and therefore your self-worth, but it instills doubt for the client as well. On a subconscious level, maybe they'll challenge you on the price, or maybe they'll just have a seed of doubt in their heads and can't necessarily say why. That might result in you losing respect. Okay, mistake number 5 is basing prices on time. And there are 2 ways of doing this. One is billing by the hour, so that they get this after the fact bill, or you're basing your prices based on how long you think it will take to do the job. At the end of the day, people don't value time. They don't care how long it takes to do a job. They just want the job doing to the standard that it should be done to. People are afraid of surprise bills. Now, whether that is billing by the hour, or you've done some extra work for them, you've not negotiated in advance how much that's going to be, they've had a surprise bill through. People hate that. And quite often, you know, you might end up writing some of that time off either way. And let's face it, that hourly rate that many of you charge, and I speak to a lot of accountants, and sometimes, you know, and it hurts my feelings to say it, but sometimes that hourly rate can be as low as £15 per hour, right through to £400, £500 per hour. And as you can imagine, there are different consequences with each of those different prices. But where does this hourly rate come from? It's just an arbitrary number. Mistake number 6 is there's ambiguity in terms of what they're going to get for that price. They think they're going to get absolutely everything. And you think, well, okay, for this price, this is all you're going to get. Which means actually sometimes, you know, the expectations are going to differ. They're going to expect a lot more from you than you want to give. This can also result in fee disputes. You end up resenting them. You feel maybe that you're being taken for granted. They become not profitable. And again, respect and appreciation comes up time and again, you'll notice here. You certainly feel undervalued. Mistake number 7 is thinking that your overheads will affect the price. And people do this in different ways. They'll say, well, you know, I don't have the overheads of a lot of these other accountants, therefore I can justify a lower fee. Now, it doesn't matter whether you're a 2.5 million practice with 30 team members in a plush office or a 1-person band working from your spare bedroom. The price shouldn't reflect your overheads. It should reflect the value that you are bringing at the end of the day. Okay. Mistake number 8 then is sending a proposal after the meeting out and saying, look, let me think about it. Let me send you out a proposal, rather than asking for the business in the meeting. You have to strike while the iron is hot. Every minute, every hour, every day that passes until they've received that proposal, whether it's email or posted, they're going colder and colder. You have to strike while the iron is hot. Mistake number 9 is accommodating the client when they say, look, I'm just after a price. I've only got 5 minutes, just skip to the price. Or I just want the basics. The implications are that you're immediately on the back foot. You've not had time to really seek to understand what they want and need. And by seeking to understand what their aspirations are, what their business goals are, you can then put forward many of the opportunities that you can bring through the services and how that will help them. You can demonstrate the value. Okay, let me move on. Mistake number 10 is that almost, whilst you're having the conversation, you start off with a number in your head, and then this number is coming down, not because of the client, but actually you're convincing yourself that they probably won't want to pay that. You're prejudging the client. So you crash the price before you even mention it. And then, of course, they may go even further and negotiate you down. You don't know if you're going in too high or too low at this point because you haven't had the opportunity to demonstrate the value and find out their perception of it. And so, yeah, it may be that you're going too cheap, or perhaps you are too expensive because you haven't properly demonstrated the value. So mistake number 11 is trying to accommodate too broad a range of clients. Any GRF is good. GRF is often an expression given by accountants, but actually that's not the case, because when you're trying to be all things to all people, you're spreading yourself too thin. It doesn't give the chance really to create consistency in your pricing strategy. Mistake 12 is, and it's kind of related to mistake 10 really, is that you'll go in low thinking, well, look, I'll just win the client over, and then over the next few years I can start to ramp up the fees. But the problem is you've trained them on day one that these are your prices, this is the value, and I'm not saying it's impossible, but it's not easy to change that going forward. If they've come in because you've won them over on the price, then all they're going to do maybe is start to look for the next accountant that's just as cheap by doing that. And then my final mistake that I want to share with you is, and again, this comes down to prejudging the client, is that you make assumptions on how much they'll be prepared to pay, what they're able to pay. And quite often we can charge too low, or don't talk about those additional services that you could offer, you could deliver that might help them, because you haven't understood their wants and needs. So they're the mistakes. Let me just check my chat box. Okay, Sharon, this is down to Quantuma, but I'm very happy with that if Quantuma want to hand these out. But oh, sorry, I realised that only came to me, so that for the benefit of everybody else, I was asked by Sharon if it was possible to get a copy of the slides. So I'm quite happy with that. Now, look, it's really important that you have a clearly defined pricing strategy. Not having one means that you're constantly trying to judge how much to charge. It's very difficult to do that. And quite often we can be looking at the person's face that we're dealing with and making an assumption based on that, rather than having a proper pricing strategy in place. Sometimes you're profitable, sometimes you're not. And you're not always delivering the types of services that you'd love to. So look, take this down. If you don't write anything else down, if you don't have a pricing strategy right now, it has to start here. First of all, think about the types of services that you really want to deliver. Do you just want to deliver year-end accounts as a service, bookkeeping, payroll, those types of services? Do you want to actually deliver much more management accounts, cash flow forecasting, budgeting, those types of services? Do you want to deliver an advisory service? What are the types of services that, if you could wave a magic wand, all or at least most of your clients would be going for, because you enjoy doing those types of things much more? Start with that. Then, of course, you have to find out, well, what kind of clients will be receptive to those services? From that, you can start to define your ideal client profile. And then obviously you've got to decide, so what are these types of services worth to them? So they're your starting points on creating a pricing strategy. And remember, what it's worth to one person might be very different to the next person. And this is why it's so important to get in front of the right types of clients. Now, I just want to share a couple of findings here. Sage did some research a while back, and they discovered that 1/3 of businesses don't think their accountant saves them money. And surprise fees were in the top, pretty much top of the list of frustrations for businesses. Now, a few more things I just want to share here. 32% of businesses said that they hate surprise bills. That was one of the biggest frustrations for them. 21% of them said that they're looking to review their relationship with their client over the next 12 months. So we have to be very mindful of that. And by the way, you know, changing accountants now is probably easier than it has been in previous years, hasn't it? 49% stated that understanding the business needs was the most important criteria, far more than price. 49% of businesses said that. And yet, understanding the business needs is something that few accountants really take the time to do. It was mentioned earlier about understanding their goals, their aspirations, what do they want to achieve in the next 5 years. From that, and only from that really, you can point them into the right direction, you can present opportunities on how you can help them, but at least everything is going to be mapped directly to their needs. Now look, in accounting there are two basic types of pricing. One is the cost plus margin billing. You know, in other words, what it costs to deliver that service. So that might be taking an arbitrary number that is your hourly rate and billing after the fact. Now that elicits fear. I mean, few of us enjoy getting into a taxi where we can see the clock going up and we've got no idea how long that's going to keep going up for. You get stuck in traffic, that's nobody's fault, but you're the one paying the price for it. People hate surprise bills, it's uncertainty, and it also rewards inefficiency, doesn't it? The other one, of course, is the fixed price, but it's still an estimate of time and cost, taking those overheads into account. And quite often it means that the clients are paying for what they need rather than what they value, because you've not had those types of conversations with them. And I know that many accountants end up writing a lot of the stuff, writing it off. So that for me is a lose-lose all round. The clients aren't necessarily getting the best or the best opportunities presented to them for the right price, and you lose as well because it often works out to not be profitable. Value pricing is, of course, the alternative. In other words, what it's worth to the client, and what you're charging may be worth, you know, it may be worth more to them than that, or it may be worth less. Either way, the onus is on you to be making what you deliver much more valuable to the customer, so that they're happily paying a premium to you for a premium service that's profitable, and you enjoy delivering it as well. That is a win-win. Now, look, you may or may not agree with this, but from a business owner's point of view, annual accounts don't make easy reading. They don't show how well they're doing compared to others in their industry. They don't identify strengths and weaknesses. They don't calculate scope for improvement. They don't support decision-making in business. And as I say, to a large extent, I'm not suggesting this is an absolute no-no. To a large extent, it's out-of-date data, isn't it? They don't show all of the numbers that matter, truly matter to a business owner. They simply meet the needs of Hmrc and Companies House, not the needs of the clients. And as a result, clients don't value them very much and therefore don't want to pay very much for them. And I often give the analogy that it's like taking your car for an MOT. You know, what do they do on an MOT? They have a checklist, they're hitting the car with a hammer in a few different places, they're checking it out. So why would you pay more than you need to for an MOT? From a business owner's point of view, that's what they see accounts and all of that kind of compliance work. From their point of view, they're laymen, they don't understand everything that goes off. From their point of view, well, why should I pay more? They're all doing the same thing. They're all doing my accounts for me. So therefore, the cheapest price is the one that counts. So this is the value equation. This is how we are able to raise the fees. First of all, we have to appreciate that people value based on what they perceive to be the tangible benefits, but also there are the intangibles, the emotional associations as well that come with that. Put those two together when you're demonstrating value, and as long as that outweighs the perceived price, then you've got the value. Okay. Just check for anything in the chat box. You're very welcome, Sharon. Okay. So look, I said I would share with you some value perceptions. In that value equation, I've just talked about the perceived benefits, the intangibles. So 9 value perceptions I'm going to share with you now that you can build in when you're discussing price. First of all, the price itself is, of course, a value perception. There's a story in Robert Cialdini's book. There is a story in there of a jeweler who was struggling to sell this particular item of jewelry. She'd bought a lot of them, and she needed to get rid. Now, to cut the long story short, she was going away which she tried it in different locations in the shop, etc. She was going away on a business trip. She left a note for her assistant, amongst many other things, to on here, half the price. And when she came back after the business trip, she wasn't at all surprised to see that this had finally gone. It had been in there for weeks. It had finally gone in its entirety. But she was absolutely gobsmacked to discover that it hadn't gone for half the price. It had gone for twice the price. And the reason for that was because the assistant had misread the handwritten note that had been left. And she'd basically done a little divide sign, you know, the line with the dot above and below the dash. He'd interpreted that as being a multiplier. So he multiplied it by 2, but it shifted at twice the price instead of half. Why was that? Messages in the chat box, please. In fact, well, instead of me waiting for you to write them in, look, clearly value, the price of something will also give us an idea for what something's worth. We're often brought up with this you know, you get what you pay for type of attitude. So remember that cheap is never great and great is never cheap. Okay. Value perception 2 is how you are positioning yourself as well. So I come across, as I say, I've worked with literally just under 4,000 accountants over the past 23 years in different ways. And what I've discovered is that when I look at their websites, they're all saying similar things. They're all saying we're accountants and business advisors, we're different, we're proactive, we're forward thinking, we do compliance, we do accounts, we do payroll, bookkeeping, all of those things. And it doesn't matter what colors and images they use, they're all effectively saying the same things. Now, when you position yourself in a very similar way to your competitors, then from a customer's point of view, the only deciding factor is going to be price, isn't it? Well, they all do the same thing, just like the MOT, therefore I'm just going to choose the best price. If you can differentiate yourself sufficiently by conveying your unique value proposition, your unique selling points, your values, your mission, your vision, all of those different things, yes, you're going to have an overlap on the core offering, but there may be other ways that you can help them. As long as your value proposition meets the needs and the wants of the customer, then they're going to choose you over and above price being the deciding factor. Value perception 3 then is adding additional value, but explain it as outcomes, not the features. Okay. Now, again, I don't have too long in this session to talk about explaining value, but one of the ways that some of our accountants use is, look, you know, as a business here, we obviously want to provide better data for you, taking all of the data that you're given and provide that in a better way so that it can be analyzed, because better analysis leads to better decisions, and better decisions leads to better results for you, which leads to a much better business and therefore a better life for you. And they also might talk about the fact that many of the accountants we work with are very much aligned with the United Nations global goals, and they make impacts throughout the world based on the stuff that they do as well. So everything that they're doing is creating better businesses, better lives, and ultimately a better world. But if, you know, in terms of adding value, if we take a look at this list of problems with annual accounts that I mentioned, and then just reverse some of these challenges, make it easy reading. How can you do that with your clients? Show them how well they're doing compared to others in their industry. You can benchmark the numbers, certainly something that we help accountants do. You can identify strengths and weaknesses. You can calculate the scope for improvement. You can help them make better decisions in their business. You can obviously provide real-time information, but have regular meetings to interpret the numbers that matter to them and identify what are the additional numbers that matter to them. And then you can bring their focus in on making those numbers better for them. So rather than meeting the needs of Hmrc and Companies House, meet the needs and wants of the clients. And that way, people will value them and be prepared to pay much more for them. Value perception 4 then is make the decision simple. When you are selling your different features, your different services, then actually it can come across as very salesy. So for example, yeah, we can do your accounts here. Let me talk about the benefits of us doing the accounts for you. Oh, and by the way, you know, we can do the bookkeeping for you. Would you like that doing? Here are the benefits to you. Oh yes, we can do the payroll as well. And then before long, this starts to feel a little bit salesy. You know, the customer's thinking, okay, you know, that's enough. You're starting to feel uncomfortable now that you're talking about more. And you might draw the line at maybe 2 or 3 and think, I don't want to overdo this. Likewise, you know, you might present them with lots of different ways that you can help them. But then that starts to get confusing because too much choice actually creates paralysis. How many of you have been in a restaurant? You've had the biggest menu in the world and you just don't know what decision to make because there's too much. You fear that you're going to make the wrong decision. How many times have you looked at what the people have got and thought, theirs was better after all, I wish I'd have gone for that. So choice is actually paralysis. Now, it may be that you want to offer many of these services to your clients and make it part of your normal package. And that's what I would recommend that you do. Bundle all of these into one package. So you're not talking about lots of different things. You're talking about one packaged solution for them. Okay? And that might be your pot of gold package. However, you don't just want one of these because if you have a single price, then it might be too high or too low. And therefore, you know, you're only suiting a small proportion of people. So you might think, okay, so let me put 2 packages together. Now, if you've got 2 choices, research shows that most people will choose the bottom option. Over 2/3 will go for the bottom option if there are 2 choices. However, research also shows that if you've got 3 choices and one of them is, you know, it's platinum, it's on steroids, this is your all-encompassing, it does everything, then that shifts the decision slightly higher. So a few people will go for that top one, but you don't expect everybody to. But what you'll notice is that 82% now go for what was previously the top level, where only a third went for. Now the majority will go for that higher level one, which is in the middle, and less people go for the bottom. And that's what we call the Goldilocks effect. You know, it's just right for them, isn't it? Some people will go for the bottom, some for the top, the majority go for the middle. But you must always go through these in a top-down pricing way. Always talk about the top level first, even if you know categorically that it's not right for them. Just say, look, let me just share with you what we do. This is our top level one. It may not be right for you, but let me share it with you anyway. Talk about all of that lot. That way you've had the chance to talk about the benefits and the outcomes of doing these, and then present them with a price. And if they say, yeah, that is too much, I can't afford that, then you say, well, look, let me share with you the next one down. And then you talk about what they won't get as part of that package compared to the top one, because people don't like to think that they're losing out on something. So instead of talking about what they will get on that, you've already talked about everything. Just talk about, okay, for this one, look, you won't get this, you won't get this, you won't get that. Are you happy with that? Are you happy to lose out on those things? And then you can present that price. Okay. Confidence, I mentioned earlier, didn't I, about this? Suddenly we start to feel nervous. You must practice getting to the price. You must practice maintaining your demeanor, your tonality. Okay, you must practice getting to the price as naturally as possible. Because just remember, you are the prize. You know, don't go in these meetings feeling, oh, I must win this work, because you will come across as desperate. You are the prize. And when you have that demeanor, then you're going to have that air of confidence. Actually, people are much more willing to take you seriously and therefore want to work with you. Just remember this, you'll never get paid more than you think you are worth. Value perception number 6, what is and isn't included. You must make this clear so that there's no room for different people having different expectations. Okay, so again, the pricing software that I mentioned earlier produces a fixed price agreement, which shows exactly what is and isn't included in there. And also, number 7 is give assurances, put guarantees in place. Let them know that, you know, they can call you as often as they like because it's bundled into the price, but also that you guarantee the value. Okay, and this explains exactly what that means. State your terms. Talk about the fact that, you know, you take payment only through direct debits if that's what you do. You're not available evenings and weekends if that's what you want. Whatever your terms are, convey them. Be very, very clear about it, because again, this will raise the respect factor. And you've got to be strong with your close. Value perception 9 is being strong with your close. Okay. In other words, go straight in there and say, look, so shall we sign you up? Okay, let's just fill in the direct debit form now whilst you're here, and just be strong. Now, I said that I would address a couple of these concerns. I'll think it over. We hate it when people say that. And the reality is quite often that means a no, and you end up chasing them. If somebody says, I'll think it over, let me think about it, then really it means that you've missed something out. They've not really seen the value, but maybe they're afraid to ask. Okay. And if they say, look, I need to discuss this with my business partner or my life partner, then actually you can say, well, what kind of questions do you think they might ask that you haven't yet? That's an easy way out. But also just ask them, you know, what's niggling at you? What would make you go for this now? Don't be afraid to ask those questions. If they say, I want to think about it, it's only because there's a niggle inside their head that you haven't addressed. So find out what that is. Okay. And look, you know, quite frankly, if you believe with integrity, honesty, ethically, that you can help them get to a better place by providing the services that you've talked about with them, then unashamedly serve them. And this is about serving them by giving them a nudge to commit. So ask those questions. The final one that I want to address now in this session is the question where they put you on the spot and say, look, you know, I haven't got time for all that. Just skip to the price. Maybe they've been getting some quotes from people. I just want the basics. You have to be firm with them and say, look, you know, I can't do that. I can't just jump to the price because I haven't had the opportunity to really understand what it is that you want and need. Let me ask you about your business. I'm not like those other accountants that'll just do the rock bottom service for a cheap price, by the way. You know, if I can understand what you want to achieve, then I can make sure that everything I'm doing for you is getting you towards those goals. Let me share with you, by the way, I was recently speaking to one of our AVN member firms. In fact, I was interviewing him for a podcast interview. And so he talked about how he will address those simple questions where it's, oh, just give me a price. I'm just going to share that with you.
And actually, one of the things around that, Patrick, is not to focus personally on price. So if a client rings me up and says, I want to quote, I just have a very simple tax return, rental property, and I have a P60. And I just want a price. I'll say, well, actually, do you know what? I wouldn't be even interested in, if that's all you were interested in, you will find somebody in the golden pages who will do it cheaper than me. Yes. So why waste the time talking to me? Because I won't be the cheapest. And I'd hold my hands up and say, I'm not going to be the cheapest. So if you make 5 phone calls, and then sometimes I tell them what the typical price would be. So, and I would say, look, so you can feel good when you get that lower price. But if you ever need somebody that can deliver value on the job, and you think there's value to be delivered, so maybe you've got a tax problem, or maybe you're not sure that you're claiming all the reliefs that you should be claiming, then by all means come back to me and we can have a chat. But if it's only price you're interested in, keep ringing. Here's a benchmark so you can feel good. And I've even had 1 or 2 people ring me back after that conversation and say, look, can we just have another chat? It's not only about price. Because most people, they'll say that because that puts the other person on guard that price is important. But I think a lot of times, clients, it's not the only thing that's important.
Okay, so I just wanted to share that with you. As I say, for many people, it's a stumbling block, but it's a great way of just getting around that. Don't let them think that, don't let them put you on the back foot. As I said, we're brought up with the expression that you get what you pay for. And so I want you to take away these 2 quotes. The more you pay, the more you pay attention. And cheap is never great. Great is never cheap. Remember this, accountancy is a noble profession that makes a profound difference to its clients and deserves to get really well rewarded for doing so. And you deserve to get really, really well rewarded for doing the stuff that you love doing. So please don't undervalue yourself or the profession for that matter. Okay, so look, I think I've finished. I think I've finished a couple of minutes early. So if there are any questions, please don't hesitate, pop them into the chat box. I haven't seen any apart from asking if the slides are available. I'll be very happy to send them on to K3 Hub and they can be distributed out. I'm very happy with that, of course. If there are no questions, I shall just make myself disappear and make that final contact slide large and say thank you very much for coming along. So not seeing any questions, so on that basis, I'm going to say thank you very much and I'm going to make myself disappear. All the best to you all. Bye-bye.